Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Hello, everyone, and welcome to today's Savant webinar. Today, you'll be joined by myself, Jeff Lewis, financial advisor here in Rockford, Illinois, alongside a colleague of mine, Teryn Fitzgerald. Teryn, you want to say hello?
Yeah, hi, Jeff. Glad to be here today to discuss this important topic. I think we're talking today about how to turn your savings into retirement income. So I think we can share some pretty good insights today.
Yeah, I think there's a lot of general principles that we'll be talking about today that can apply to everybody, but the focus of today's webinar will be on turning $1 million worth of savings into retirement income and how you replace that paycheck once you fully separate from your job or you retire or whatever it may be. And so we're going to be going through a handful of different topics today that we've kind of segmented into 3 different sections. But obviously, I think, talking about this ahead of time with you, Teryn, we felt like it was really noteworthy to at least talk about some of the challenges that people face when they're trying to transition into replacing their paycheck. So let's go ahead, let's start there, and then we'll obviously get to the other agenda topics as well. So thinking about, challenges, how to manage them early on in retirement, there's going to be challenges that every retiree faces, and some of them are going to be more unique to a specific individual like yourself, or some may be just generally across the board that it applies to everybody. When I think about inflation, inflation tends to be a key risk or a headwind for a lot of retirees. You've transitioned into a life where you are now living on a fixed income and you are, kind of being forced to, plan for your future in a world where you're not receiving a paycheck from somebody, where you're not guaranteed maybe a raise every year based on your job performance or things of that nature. Obviously, another risk that people are worried about these days is longevity risk. People are living a lot longer. Advancements in technology and medicine continue to allow for people to not only recover faster from illnesses and injuries, but it's also quite significantly expanding people's time horizons via the way of just living longer. So that's a big one as well. For others, there could be a savings gap that they're looking to maybe close, based on however many years they have left in, before they retire. But then obviously there's things that are outside of all of our controls, right? Market volatility, everybody's withdrawal rate, personal withdrawal rate, the percentage you take out of your portfolio is going to look a little bit differently, right? It's not going to be the same for everyone because everybody lives a different lifestyle. But I think all of these variables that are out there, as I mentioned, some are in your control, some are not in your control. And so how do you face these, proactively and being thoughtful and strategic around these, knowing that, hey, if I live for another 30 to 40 years, right? And I think people who are retiring today at age 60, I think there is a realistic expectation with the advancements in medicine today that they could easily be living till age 90 or 100. I don't think we're that far away from what the world will look like. And so just making sure you plan properly and you're taking conservative assumptions into your retirement plan, and you're not just kind of trimming hairs or cutting by the edges and not being as conservative in some of those assumptions, I think is really important. In terms of how do you assess your current situation, right? Like, how do you kind of sit down and say, where do I stand? There's 2 ways I think you can go about it. I think for today's presentation, we're going to first start talking about spending, right? One of the most important levers or determinants of how long money is going to last is going to be based on how much money you are spending either on a monthly or an annual basis. If you're anything like me, and this sounds a little weird to say as a financial advisor, but I've always really struggled with like budget worksheets. That's just not how my brain works. So many expense items, come in either on a semi-annual basis, or maybe they're annually. It's hard to account for everything. I think one day, in today's day and age, what we've noticed with just the general use of credit cards has in some ways made it easier for people to track their monthly spending, because so many people are just utilizing their credit cards to track their current monthly expenses. Now, if that's not you, that's okay, right? You can still utilize the budget worksheet spreadsheet that we have, and you can kind of go line item by line item and identify how much you're spending on a monthly basis. But for those who really struggle with that exercise, I always say, a good rule of thumb is, take your average credit card balance, add your mortgage payment, any car payments you have to that, any ancillary one-off payments that you may have, like homeowners insurance or car insurance. And hopefully that gets you to a general idea of what you may be spending on a monthly basis. The other most simplistic method is to take your net paycheck that you're getting from your job today and multiply it by 26 pay periods and just assume you're spending all of it, right? Those are some conservative ways to arrive to a monthly spending number because I can tell you, and just speaking with individuals, it sometimes can be very burdensome to go through kind of the general transaction ledger and figure out what exactly am I spending, and how do I arrive at some of these numbers. That can sometimes be an exercise that actually turns people away from the exercise of going through and looking at their personal savings. And so when I talk to, individuals, let's just say, hey, let's try to plan for the 90%, right? Like let's get directionally correct on some of this so it helps you start making some decisions. Ultimately, I think that's better than nothing. So don't get too paralyzed by trying to create a budget for yourself. Try to get something directionally correct, and then you can always refine your assumptions in your budget from there. So I said you can kind of look at this from two different angles, either budgeting, or in this case, you can look at it from, okay, what assets or retirement income am I going to have once I am retired? So this is kind of the other lever of this, right? The sources of retirement income you're going to have. Some people tend to keep a lot of cash, in the bank. Others obviously have been contributing to a 401k or an IRA or a Roth IRA over their working years. Those are generally going to be considered what are called your qualified retirement accounts. Some, individuals may have brokerage accounts that they've been saving to. So these are generally just individual or joint accounts that you may own with a spouse. You contribute to them kind of on an ad hoc basis. There's no tax deduction for making these contributions, but it's more of a longer term investment account that's not being used for short term needs in that manner. In addition to that, you've got obviously, income sources, Social Security, pension, part-time income. Some people may have a second or a third property where they are renting that property out. You've got all of these different moving pieces, and it's like, how does all of this come together? How do I, effectively make the right strategic decision on something like Social Security while also managing kind of the other assets or other income sources that I may have? So when we put all this together in like a financial plan, really what this allows you to do is look at all of these different income sources and put it all together, right? So identifying goals. And when I say goals, generally we mean things like spending, right? So what are you going to be spending money on in retirement? Obviously, if you're going to be spending money, you also have to have a good documentation or ledger of assets of, okay, what are all of the assets that I have that are either income producing that provide me income, or maybe doesn't provide me income today, but I know if I live in my house today, I have a primary residence. If I have to sell that home in the future and then live off the proceeds of that home while I move into like a nursing home or something of that nature, well, that's still an asset. You want to account for that in your financial plan, but it's not an income producing asset today. Whereas maybe potentially 20 to 30 years from now, you want to include it as an asset that could be turned into cash, but you don't have any plans to sell it today. And then I think kind of taking a step back and thinking about this more at just like a higher level, open-ended questions, how much can I spend? How much do I want to spend? I mean, those are important questions to identify early on. Particularly, hopefully you're identifying the answers to those, hopefully before you retire, just so you've got a good idea around cash flow needs once you're retired. But then kind of what gets in related to that is how much risk can I take when I'm retired? And then in addition to that, how much risk should you take, right? So there's kind of two questions there that can be hard to identify. And I think obviously taking a step back, understanding what assets, what liabilities do you have today? What different income sources are you going to have here in future years going forward? And then really, how does this all get built into a financial plan, right? Like that can be very daunting for some. For others, it could be a really thrilling process that gives them a lot of energy. But generally, what we find, a lot of people are looking for a soundboard. They're looking for a second piece of wisdom or words of encouragement around, like, hey, am I thinking about this correctly? Is this generally how I should be thinking about it? And I think that's where obviously having someone like a planner to help you go through a financial planning process can be very fruitful and be additive as you start this next chapter of your life. So I talked a lot about putting together a financial plan, but how do you interpret the results of that? Like, what does that actually mean for me? What does it mean for me, my spouse, maybe kids if you have kids? If you don't have kids, charity, other heirs. What does all this actually mean? Because I think what you find when you go through that planning process is there's a lot of assumptions that end up needing to be made. And if you don't understand the assumptions, I think it is could leave you feeling either kind of like a little confused on like how does all of this come together, or like how do these variables all play and impact kind of what I'm looking for the next 20 to 30 years. And so we kind of identify when we stress test plans, when we run a Monte Carlo analysis, we look at really kind of three key areas of like, I don't want to say pass fail, but it's like needs a lot of improvement, on the right track, or potentially you've got room to do more with your retirement, right? And I kind of categorize it into those three. You'll see here on the screen, it's like below confidence, in the confidence zone, or above the confidence zone, right? So generally speaking, you're going to fall in one of these three categories by default once you go through your retirement plan. And then I think assessing from there, okay, you're either on the right path or you need adjustments. And sometimes those adjustments aren't always you need to save more or you need to spend less, right? Sometimes those adjustments are you need to spend more, because if you don't spend more, this could be a bigger problem later on in life for you, potentially for heirs if you have them, and if you're worried about them inheriting a large sum of money and that's not something that's important to you. If you don't spend the money, well, then by default, the money could likely continue to grow. And that may not be what's most important to you. And I think identifying that and working with somebody who understands putting together a financial plan that isn't just about continuing to grow the assets, I think is really important. And I think that's where a lot of people's job, or our job, comes in. It says like, what are the things that are really most important to you? Because if growing the assets from this point on is considered a failure, we should not be putting together a financial plan that continues to grow the assets, right? Like we should be hearing that from you as an individual or a person. So this is kind of the fun part of our job, is really getting to know people and seeing what the next 20 to 30 years of their life looks like. And if you haven't gone through this process with an advisor before, generally I would say you should do this as soon as possible, especially if you're thinking in the next, 2 to 5 years, I'm going to be considering retiring. That is the time to start having these types of conversations and these types of like statistical modeling. So when we think about challenges, how to manage them, one of the things is obviously investments. Your investment portfolio is what's going to drive your future income, the potential income you can take from the portfolio. It's going to drive the dollars and the cents in terms of what the values will be worth in a future state. And so I always say, appropriate investment allocation is needed. That needs to be solidified first. That asset allocation should be managed based to obviously a risk profile that you're comfortable with. But also as part of that process, there's disciplined rebalancing that needs to take place to ensure the assets maintain the asset allocation that you're comfortable with. When you think about rebalancing, that's the old adage of buy low, sell high, or buy high, sell higher. Maybe not the latter, but buy low, sell high. Keep the overall mix of the investments together based on the risk tolerance you said that you were comfortable with. Because if you fail to rebalance and stocks continue to perform well and you never address the issue, well, then your 60% stock portfolio could, over the course of time turn into 70%, 75, 80% stocks, and you may not be comfortable with that, right? And so having a disciplined process to revisit those things, I think about asset location, tax location, those terms can be used interchangeably. Kind of managing your overall investment portfolio from an overall tax management perspective is really important. Obviously, having a structured plan in place for withdrawals, making sure that your withdrawals are not only within reason, but they're meeting kind of your monthly or quarterly or annual income needs. That's really important. And then obviously, I think when it comes back to investment management or portfolio composition or construction, I think one of the most important determining factors is just making sure that you're well diversified. When you think about stocks, when you think about bonds, all of these different things perform differently over time. These investments are not meant to act the same. And I think, Teryn, if we go ahead and go to the next slide, I think the test of time is really, this is probably not news to anybody, but stocks are going to be the engine that makes the portfolio grow, right? So given enough time, stocks will tend to outperform other assets like bonds or cash. And so you're going to want to make sure that if you're retiring in your 50s or your 60s or even your 70s, you're going to want to make sure that you still maintain an allocation to stocks likely just because they're going to be your best hedge against inflation. They're going to provide you the most protection that your dollar today is still worth a dollar tomorrow, or maybe even a little bit more than that. So you don't have to necessarily sacrifice the lifestyle that you've grown accustomed to. Now, is that saying you should be 100% stocks? Probably not, right? Like that's a different conversation for a different day. But having that mix, having a mix of both stocks and bonds and cash and how that all works together in terms of actually distributing the money to replicate your paycheck is obviously very important in that regard. So, we talk about this term buckets gets thrown around a lot in financial services and as financial advisors. And so we talk about different buckets from time to time. And so when we think about buckets, generally there's kind of three buckets at a very high level. Generally, there's like a short-term cash bucket. This is going to be money that generally is kept pretty liquid, cash in the bank. Probably it's money markets, checking accounts, savings accounts, CDs, high yield online savings accounts. That's kind of like your safety net or your nest egg. And then thinking about this a little bit further out, there's probably a bucket of money somewhere between 3 to 7 years, maybe 5 to 7 years. It's going to be more intermediate. You're going to think about this bucket as like, hey, I don't need the money now, but I'd like to have money set aside for this maybe in a handful of years. And then there's that longer term bucket, right? So 7, 10 years down the road. I don't need this money. I don't need any of this money right now, but I want, something there that's going to provide me future income later on in life. And when we look at these three buckets, each of these three buckets really takes on a whole different risk profile in terms of how they're going to be allocated, right? Your longer term monies can take a little bit more risk because you don't need the money right away. So that's generally going to be invested in more things like a diversified stock portfolio. Your intermediate term bucket, well, there's a trade-off, right? There's an opportunity cost to holding money in cash. It feels really good, but the opportunity cost is that it could be earning a higher yield by placing it in a different type of investment account. And so generally speaking, when you're talking about expenses or an investment being made 3, 4, 5, 7 years from now, that's where you start getting into this intermediary bucket, where it's probably going to be invested in things like bonds. Maybe you have some exposure to REITs as well. But that's going to be it's not going to be a diversified stock portfolio, but it's also not going to be cash. It's generally going to be made up of bonds. And then, as I already mentioned, your short-term bucket, this is going to be cash, right? This is where you generally are going to pay your monthly expenses from, maybe your property taxes that come up, once or twice a year. Generally, that's going to be your short-term bucket. I think of this as up to a year's worth of expenses. Some people like having a little bit more. Some people like having a little bit less depending on what their job situation is. So there's a lot of things to be thinking about there. But in terms of how we put all of this together, how we actually replicate a paycheck, right? So we've got an example for you guys here today. So visualizing your buckets, right? So, in this example, there's an individual who has a cash flow need of, roughly $6,200 a month, right? And a portfolio balance of $1 million. Where does that money come from to eventually replace the paycheck, right? So you've got three buckets: savings, you've got bonds, and then you've got a diversified stock portfolio. Well, most people like having a certain level of savings, right? Like generally they don't want to see their savings or their cash in the bank dip below a certain amount. So for this example, we use 75,000. So we say, okay, every month we know $6,200 a month needs to come out of the portfolio, and we're going to replicate the paycheck that they were earning while they were working. Well, depending, during different times of where the market's at, what cycle the market is, you may either rely more heavily on bonds to replicate that paycheck, or you may more heavily rely upon your stocks to replace that paycheck, right? So I think about, the last 12 to 18 months in the market, what's been doing really well? It's been stocks. So when stocks are doing really, really well, that natural rebalancing process from selling from your assets that are generally doing much better to create cash flow for you is generally the more prudent way to go about replacing your paycheck. So during times of stock market doing really, really well, you're probably selling from the stocks, taking those winnings off the table, putting that money in your bank account to replace your paycheck. But what if you retire in February of 2020, right before the pandemic, or if you retire in September of 2007, right before the 07, 08, 09 crash? Where should you be going to replicate your paycheck then? It's generally probably going to be bonds, right? Bonds tend to be more stable. They tend to be more capital preservation in nature, and they don't come with nearly as much volatility as stocks. Now, does that mean that they're completely risk-free? No, it does not. But they generally hold up much better during times of stock market volatility, which is why they play a role in your portfolio for generating cash flow. And so when you think about the different buckets that you have, this is one way to think about it as you start thinking about replacing your paycheck. So when I think about this, and Teryn, I know you've got a lot of good thoughts on this as well. There's kind of two components to this, both psychological and practical. The psychological piece is when you start replacing your paycheck on a monthly basis, you're kind of dollar cost averaging out of the market, right? So every month you get a distribution from your portfolio. It doesn't really matter what the market's doing at that time because on the 15th of every month, you're getting a paycheck for $6,200 roughly, right? So it takes the psychological aspect out of like, ooh, is this a good time to be taking a distribution from my portfolio? Should I wait a couple months? Generally you don't want to be thinking about it that way because that generally means your emotions are getting in front of making a good financial decision. So generally we see a monthly distribution tends to work really well for a lot of individuals. It's not for everybody, but generally most people like the monthly distribution. Sometimes you can stagger your monthly distribution to be either towards the beginning of the month or the end of the month, maybe depending on when you get a Social Security paycheck as well. So that way you're kind of replicating almost two types of paychecks once you're fully retired. But then there's always the more kind of practical nature when you think about income and safety, the buckets they provide protection for many years. Teryn, what's the rule of thumb that you use in terms of like having that income bucket solved to kind of replace their paychecks? How many years do you typically advise as a like general rule of thumb for having that money in things like cash and bonds for cash flow needs?
Yeah, for cash, I'd say, I mean, what you put on the slide is pretty accurate. 1 to 2 years is a good period of time to have. Some people are going to be more aggressive and less aggressive on that. So we do hear from time to time, you know what, I feel comfortable, or I have this pension that's really paying me income, so I don't need that much cash available to me. And that's perfectly fine. It's a flexible amount. This just kind of gives you a rule of thumb or something to start thinking about. What I'd add to all those excellent points that you said earlier, Jeff, is that in my experience, the bucket strategy just helps organize and prioritize your spending. And it gets your mindset right for retirement, right? So a lot of times this change for retirees is kind of one of the biggest risks that they face is, hey, I went from save, save, save all my life. I keep hearing save, save, save. And now I have to switch it to I'm spending these assets. And you don't take that lightly. It actually is a really big change in your mindset. And so when you look at pairing things like preparing with a budget worksheet, or Jeff mentioned some simpler ways to put that together, preparing with that and financial projections, but then also having something that's like logical that, hey, how do I pay myself? Oh, this bucket analysis isn't just addressing my short-term needs, it's also here for my long-term needs as well. I think that gives you a lot of money in the bank as far as your mindset goes, as well as saying like, hey, I'm prepared on all these different fronts. I've done the work. I'm here. I have a logical way to get the money to me, and it just makes a little bit of a smoother transition to retirement, I'd say. So we'll give Jeff a little bit of break, and he wanted me to talk about the most exciting topic of today, which is taxes. So everyone, get excited for it. So with that, we'll move on to the taxes piece, because that's a very important piece of retirement as well. Unfortunately, retiring doesn't save you from what we all suffer from, is having to pay the taxes, and it is a very important part of financial planning. What's scarier about it, I think, to some degree for retirees is there is a little bit more of I have to actually be engaged in planning for my taxes, at least. A lot of times we have our employer, withhold our income taxes for us. Maybe we'll have to make some estimated tax payments, maybe not. Maybe you just wait until we file our tax return. But there's not too much a lot of times people are really thinking about as far as taxes go when they're in retirement or prior to retirement. And so that switch is a little bit different than when you have an employer taking care of that for you. So first we'll talk about how much you actually get to keep. So we talked about that withdrawal strategy, the bucket analysis, and we start to think, hey, we did this budget worksheet, how much am I spending? And then you have to think, well, how much do I actually need to withdraw? Because I don't get to keep all of it, right? And so it's going to be important, I'll probably say this a lot of times, to work with a tax professional, because there's a lot of things that need to be planned for. But it is very important for us to plan for those income taxes. So some important questions I would say to ask yourself, and it kind of goes through this here on the slide, is what is your gross pay from the accounts? So this is how much you're actually withdrawing. Like I said before, the part you keep, and then there's also a part that you won't see, or you might be making estimated tax payments, but a part that's going to the IRS, that you're actually giving a check to the IRS instead. It's still a withdrawal. It's still income coming from your portfolio. So we need to plan for that tax piece as well. And then what taxes are you paying? So depending on where you are withdrawing from and what state you reside, you might have different taxes to account for. Some states don't tax retirement income, some states do, or partially. So you really have to start thinking about, hey, how do I plan for taxes now that I'm retired? And we'll get into kind of the different types of accounts as well, because that's going to make a difference as well. And then there are the other expenses that might need to come out. So one common thing that sometimes people are surprised by is, your Social Security check. You're getting a statement from the Social Security office, or you log on, you see this, dollar amount, and then all of a sudden it's not the amount that you receive. Well, that's because Medicare is typically coming out of it at 65. It will definitely come out of it, and so you're not getting that net amount that you thought you were, because there's a portion that's going somewhere else. And then there's what other strategies are available to help you reduce your taxes. So, one thing is, and this is part of the financial planning process, are you charitably inclined? Are there other options that are in your portfolio that can reduce taxes? Jeff went through some of the things that we think about when we talk about taxes, like rebalancing and tax location. Well, there are strategies out there that can reduce your overall taxes just within your portfolio by, shifting bonds, for instance, into your IRA might be something that makes sense for you, or, having things like stocks be in your brokerage account instead. All those things are going to add to your bottom line, and your bottom line is ultimately what your net worth is, ultimately what your assets are. So these are really important things to consider, I'd say. Now, again, make sure you're working with a tax professional. So that's a two. I said it twice now, but because it's really important. We see some unintended consequences when some people are trying to do this on their own. There's a lot of things that, let's just face it, doesn't make sense when it comes to taxes. So we want to be really thorough when we're planning. So that kind of leads me to tax planning. This is going to be a lot different than when we would call, preparing a tax return. So, a lot of times people are like, I have an accountant, I have a CPA, they prepare my tax return, I'm fine. Well, that's fine, and that's great, and that's an important thing to make sure it's accurately, prepared for you. But at that point, the work has actually been done. There's not much you can do at this point in time because the year's over by the time you file your tax return. Right now we're filing for 2025 and it's 2026 and the year's over. There's not much you can do there. So a good tax plan is going to be actually doing a work proactively. We're going to review tax brackets now. We're going to review it for years to come and look for strategies that are adding to your bottom line. A good tax plan also means can mean, I should say, paying a little bit more tax upfront with the goal of paying less taxes over your lifetime. So sometimes that can be a little scary of, hey, this is actually adding tax to me right now. Well, that's okay. We want to look long term and say if we do something now that actually could really benefit us and set us up long term. And so we need to pay attention to that because again, that's adding to your bottom line at the end of the day. So starting with a review of your account types, there are three main account types or buckets. I might say either one of those things because as Jeff pointed out, we love as financial advisors just use the word buckets. Just a nice visualization, I think, is why that's out there. But there are three different types or buckets of accounts that we're looking at. And they all do actually have different tax consequences. So we need to start paying attention to that. Prior to retirement, it's important, but definitely in retirement when we start to think about smart withdrawal strategies. So let's start with the taxable account. So this is going to be your brokerage or after-tax dollars. A lot of times we're saving into this as an investment account outside of our retirement accounts. So I have extra savings every month. Where am I going to put it? I'm funding my 401k. You're probably putting it into a taxable account. That can be something like a brokerage or an individual or a joint trust. There's no tax benefit for putting it into it, like a reduction in your income today or, later down the road there, but it does help save into that taxable bucket. And it offers a lot of flexibility in retirement too. So sometimes people don't fill this one out quite so much. And, as you get into retirement, you're going to see that it's setting you up for a lot of success to be able to have different levers to pull when it comes to different types of retirement accounts. And then there's also the tax deferred account. So that's going to be probably a lot of times, honestly, it's the biggest bucket that we see retirees have. So they're saving into this because this is their 401k, their 403b, their IRAs, could even be a pension. And what typically is happening is they're putting contributions in these types of accounts. They're getting a deduction for the amount that they're putting in there, and then it grows tax deferred. So in other words, all the earnings as we invest, all that growth, we're not getting taxed on it year to year. But at some point in time, there was no taxation to this account. When you pull money out of it, there is going to be. So that's a big key to the tax deferred account is when we've a dollar out is a dollar taxed, so to speak. So it's a good bucket to be in. It's usually the largest bucket that we see retirees have. It's something that's advertised. Sign up for your 401k. Is there employer match? All those great things that come with a tax deferred account. But it's not the only account out there. So just keep that in mind if you're still planning for your retirement. And then there's finally the tax-free bucket. So that's going to be your Roth 401ks, 403bs, and Roth IRAs. I know we're not really talking per se about starting to think about retirement, but if I was someone just starting fresh, I'd really want to fill up this tax bracket or tax bucket because it's really going to give you a powerful upside to it all because you put money in it. And while you don't receive a tax deduction for putting money into it, all that growth grows tax free. But unlike with the tax deferred accounts, when you withdraw, there is no taxation. So it's why we call it a tax free account because all the growth, original contributions that you put in there, if you go to withdraw in retirement, you're seeing absolutely no tax consequence to it. So you can imagine that can be very powerful, especially over the long term. So when you look at these different accounts, and if you're fortunate to have a mix of these different accounts, it can be a little overwhelming to decide how to start a withdrawal. So as we've kind of gone through this today, there's a lot of steps to this, and it can be overwhelming to just think about this, on your own. So working with a financial professional is going to help you. But I will say this is kind of a confusing part because taxes are not anyone's friend when it comes to making it clean and simple. but we'll try today. So this next slide here is actually showing you, a couple different withdrawal strategies. So I mentioned earlier, a good tax plan is important, and this is kind of why. So most people make the mistake of looking for the account that they think is going to have the least tax consequence. Hey, I'll just take from this account. I won't have to pay that much taxes. That's where I'll start. But in this chart, we see an example of a person with an IRA and a brokerage account. So a taxable account and a tax deferred account, right? The amount distributed from an IRA is going to be taxed at that person's marginal tax bracket. So oftentimes we'll hear someone say, I'm in the 22% tax bracket, I'm in the 24. That's what this is going to be taxed at if we withdraw from the IRA. And that can be kind of the least attractive account to withdraw from in retirement. So people say, hey, okay, I'll just spend from the brokerage account. There's not going to be as much tax, there's preferred tax rates. There's not going to be as much taxation to that. Why don't I withdraw from my brokerage account first and I'll save some taxes? And that could be true, but it doesn't necessarily mean that's good long term. So in this case example, you'll see there's a 30-year span. And in the different highlighted colors, there is a split withdrawal strategy, spend the brokerage account first and spend the IRA account first to meet that withdrawal that you need. And if we see the biggest advantage would be to take it from a little bit of both of accounts. This is just kind of high level overview of this situation. Some tax planning and projections all go into this, but really, splitting the withdrawal from the different accounts really at long term added up to having the most after tax wealth when we looked at this withdrawal strategy. So if you're starting to plan for taxes, you want to know what the first step is. I would say look at your tax bracket. I don't think it's a fun thing to do is stare at tax brackets, but it's important to know because it gives you some insights of what you can accomplish within it, right? So work with your accountant and financial advisor and you come up with some projections together and say, what tax bracket am I in? Is there any room for the opportunities within that bracket? Because a good withdrawal strategy is going to say, hey, where am I today? And then start to look for opportunities within that tax bracket or even maybe beyond it if it makes sense for you. So one common opportunity that may add value over time is Roth conversions. We wanted to give you some things to think about as well as when you get into retirement, outside of just the withdrawal strategy, what could make sense if we're looking at a good long-term, tax plan. And Roth conversions a lot of times can make sense, but we need to do tax planning along with it. And I'll give you some, cautionary tale in a moment. But it is deciding to pay taxes now, right? So it is deciding, hey, I could just let this account on IRA grow tax deferred. And, if I don't take money out of it, or if I just take it from my withdrawal, I'm not adding to that taxation. But you're taking the IRA money and you're deciding to pay tax on whatever you're converting and you're putting it into this Roth bucket. Well, I mentioned earlier that Roth bucket grows tax-free. So you're going to have hopefully a lot of time on your side to grow and compound over time to build up a really nice tax-free bucket. And so what this does is give you a couple different opportunities. And they're on the screen here. You're not paying taxes on the withdrawals from the Roth. So that's a huge thing. Yes, right now you're paying taxes to put the money into the Roth by converting it from the IRA. But as that grows, you're not going to be paying taxes on those withdrawals from that Roth. A huge thing a lot of times as we're looking at this, especially as a long-term tax plan, is that it's reducing your future required distribution. So at age 73 or 75, and yes, it's two different numbers because it depends on when you were born, you are going to have to take money out of that tax deferred account, whether it's a 401k or a 403b or an IRA. Money is forced out of it by the IRS. They said, you know what, you've had enough time with this account that we're not taxing it. It's time to tax it. So every year after you turn that required minimum age, you will have to take a little bit out every year, and that will be ongoing until you pass away. So if we think ahead of time, if we're not just planning for now, we're planning for the future, we can say, well, if I start to take money out of that IRA or that tax deferred account now and put it in something like a Roth bucket, then I'm getting it away from that. And I'm getting it away from that forced distribution. Because when that happens, a lot of times we'll see stacking of income and you're in a higher tax bracket than you plan to be in. So if we can start to peel that away earlier, you might be in a really good spot because of it. And then I would also say that if you're looking long term outside of just your own financial planning, they're really great accounts for beneficiaries to inherit. So they are still allowed to have that tax free. They will have to distribute it typically within 10 years, but in that meantime, it's tax free to them where those other accounts are not going to be. So Roth conversions can really make sense. And I'm going to kind of give you an example of that. So on this slide here, we do see a chart where it looks very similar to that earlier chart, but we layered in a Roth conversion strategy. So on the top, that yellow goldish line, that's pairing your withdrawal strategy with also some Roth conversions as well. We don't have a dollar amount here. Again, that's going to go into, actually planning in your own tax bracket. But if we look at that pairing of the Roth conversion as well as a good withdrawal strategy, it added the most, and a big difference here, after-tax wealth over their lifetime. So you can see that power of planning, not just for today, but over your long term. And you can see the advantages that Roth conversions in particular can have, but it does involve careful planning. And here's my cautionary tale of that. It's not a fun word. IRMA. It's not someone's grandma's name. It's actually a real thing within the Medicare. It is a kind of hidden tax, I would call it. It's based on it's your Medicare brackets that are based on what your 2-year prior income was. So what happens is when you are, going through filing for Medicare, if you were doing that in 2026, let's say, they're going to look at your 2024 tax return and they're going to look at all the income. That means, your dividend income, your, if you were working, your wages, your Social Security, whatever is in that adjusted gross income line. They're going to look at that and they're going to say, okay, well, sir, you made 137,000 as a single person. Your premium this year is going to be $284 for Part B. So when we look at Roth conversion planning or even the withdrawal strategy, it's really important for us to be aware of this because it's not on your tax return, and in fact, it's 2 years later. So that is, it's hard to remember what you do each morning, another, and then you got 2 years later and you're like, hey, what happened there? And so it's something important that we plan for when we're looking at Roth conversions, when we're looking at withdrawal strategies. But that's why I keep saying, plan with your professionals. We definitely need your help when we're planning, so we have insights of what's going on with you. But it will be really important because there's hidden taxes, like I said, for that you might not be aware of. And you could see there's quite a big difference. So like the baseline is $202. If you got all the way to the top tier, you're at $689 just for Part B. And then they'll adjust also for Part D as well. And that's per month. So, and if you're a married couple, that's going to be times 2 if you're both on Medicare. So substantial amount. They will readjust it every single year. So they keep looking at that 2-year prior. If there's a big reason why it happened, like you retired or something like that, there are things you can do to reduce it ahead of time. But all in all, just think about, planning with your professionals because otherwise you might be in for a big surprise when you go to see what your Medicare premiums are in a few years. Okay, so with that, we kind of have come to the end of our presentation about, turning your savings into retirement income. Jeff and I wanted to leave you with some final thoughts, and then I think we have a little bit of time for some questions as well. So putting it all together, Jeff kind of went through all this first half, is assess your current situation. Start with a plan, start with a budget, work by stress testing your plan by doing financial projections, and then kind of put together your own roadmap of what retirement's going to look like for you. How are we going to withdraw? And then start to view your investments as buckets to get you in the right mindset for retirement, and plan with your professionals and your CPA and your accountants to take care of your tax situation and plan around that. And work with your advisor by regularly reviewing this and monitoring and adapting for changes. If I had to give any advice, I think the adapt for changes is probably a big, big thing. Jeff, I'm sure you agree with that as well, there's no such thing as a perfect plan. There is going to be speed bumps in life. We all know this. So being flexible is really a key to retirement. It's incredibly important to say, okay, I know this isn't exactly what I set it up to be, but hey, things change and I can change too.
Yeah, perfect. Thank you, Teryn, for wrapping that up. We did have a handful of questions that came through during a lot of different parts of our conversation today. So I'll start with some of the questions that came in early on, and then we'll kind of go from there in that regard. One of the questions that came through was basically, how do I protect my paycheck or my retirement paycheck, essentially like a distribution from the portfolio during times of market uncertainty or market downturns. And so I think this goes back to kind of what we talked about when we segued from my part of the presentation to yours, Teryn. Making sure that you do have a comfortable amount of your investments in more safer or capital preservation types of investments. Generally, a good rule of thumb, right? It's going to be different for everybody. But a good general rule of thumb is somewhere between 3 to 5 years of general living expenses. When I think about what took place back in '07, '08, the market high point was late 2007. The low point was March of 2009. And it actually took the market almost 5 full years to recover back to where it was in 2007. So during that time of extreme market volatility, where we saw a lot of downside in investing in stocks, you would have ideally liked to have, roughly 5 years worth of your portfolio in bonds, knowing that you would not have had to sell any of your stocks during that 5 year period to generate your cash flow, right? And so when I think about that, in hindsight, right? Like you don't always know what it's going to be when you're living in the moment, but in hindsight, you can use the information of what took place in the past to help inform the decisions that you make going forward. And so that's one area where, that when, reaching out to individuals and talking them through different things, that's generally a good rule of thumb, somewhere between 3 to 5 years worth of safer type of investments within your portfolio to help replicate that paycheck. Um, Next question, how will taxes impact the income I actually get to spend? So Teryn, you had touched on this, but at a really high level. So think about like those pre-tax buckets, your 401ks, your IRAs. Those are going to be come out pre-tax, so you're going to owe ordinary income tax on that. Your Roth accounts, generally speaking, are not going to come with any income tax issues. And then the last bucket that Teryn had talked about, like that taxable bucket, basically you're only paying taxes on the gains, right? So you're getting that tax on the gains. If you can wait at least a year, it's going to be taxed at more general preferential tax rates. So those are kind of the three different buckets in terms of, and how the taxes will impact you. Now, if you have a very, very large IRA and you don't have a lot of other buckets of money, well, then you're gonna probably run to a scenario where you're gonna have, quite a bit of income tax needing to be withheld from your distributions. So just be mindful of that. Be mindful of potential future planning opportunities like Teryn had mentioned with Roth conversions. Those could, be potential avenues that you could pursue. Teryn, had you seen any questions that came through on your end that you wanted to address specifically? I've got a couple more, but wanted to give you the opportunity if you had saw some that you wanted to address.
Yeah, I see a couple that I think make sense for me to answer. So one would be, how do I know if Roth conversions make sense for myself? So yeah, it takes a lot of planning, like I mentioned. I think I stressed that a lot. But it really is what we would say a green flag opportunity would be is, hey, I'm not working anymore. My income has dropped, right? My tax bracket is not as high as it was, and it might be higher in the future. So why don't I take advantage of this low rate I'm in right now and start to think about filling it up with converting to the Roth? So I would say that's probably on a high level, a good indicator that this might make sense. Sometimes people do Roth conversions while they're still working. Sometimes even when that required distribution age is upon us, that 73 or 75, where they force that IRA to have some taxation to it. Sometimes it still makes sense, right? It just kind of depends on what we're looking at and also what your goal of it is. A lot of times it's, hey, it might be reducing your taxes over your lifetime, maybe. But also maybe I'm doing it because I want my kids to have an account that they're not going to have to pay taxes on in the future. So we talk a lot before we start to entertain Roth conversions of not just income tax planning, but also kind of value discussions, I would say, of, hey, what does this money mean to you? And ultimately, what's its purpose long term? Because hey, if its purpose was to go to charity, then maybe you don't do Roth conversions, even if there's that opportunity in a lower tax bracket. Or if, hey, I might not see the effects, but my kids will, so then I'd really like to do Roth conversions, maybe it will still make sense too. So I would say it definitely depends on the opportunity or the opportunities and your values that you're looking for. And there can be a lot of different reasons why you're doing Roth conversions, but tax planning goes into it. Low tax rates is probably a good indicator that that might make sense for you. And then this one, I touched on it briefly about the IRMA, that income adjustment when it comes to Medicare, but it says, hey, what if I retire before Medicare? What is that expense? How do I plan around that a little bit? While that wasn't the topic of today, I do think it's important to think through that a little bit as well, because you might be looking at things like credits in the marketplace. There has been some changes with that recently, but there are still credits within the marketplace for healthcare. So healthcare.gov is typically where you'll find, private insurance. You're not working anymore. Maybe you don't have Cobra anymore, and you want to get some insurance. That's usually people's first line of, hey, I need insurance. I'll go to the healthcare.gov. And depending on your income, there can be planning around that as well, because sometimes there are credits available, and those credits are based on your income. So sometimes people will say, I'll put some cash aside, and that way my income will look a little bit lower and I'll qualify for credits, because the healthcare costs can be a reason why people work later, is just because it can be very expensive to have private insurance. Or people will plan around that, like I said, is say, hey, maybe I should plan around my bracket a little bit before Medicare so that my income's not so high, so that maybe I'll qualify for some of those credits, reduce some of the premiums that are associated with the premium tax credits and healthcare insurance premiums to the marketplace.
And there's just one last question that I feel like we should address, because I think it's a good question. How do I build flexibility into my retirement plan with things like one-off or surprise expenses, or just one-off expenses that come up unexpectedly? This happens. It's real. It's going to happen. This goes back to Teryn's point earlier about being flexible and being able to adapt on the fly. You're going to have one-time expenses that come up, and they're going to come out of left field, and it's going to feel like a lot. I'd say the important piece of this is knowing, like, hey, that's part of life, so don't get too down in the dumps about it. But also just understanding, okay, what's the expense? What is it relative to the assets that I have? And is this a reoccurring issue, or is this truly a one-time expense where it's like, hey, this happened, it wasn't anticipated, a storm came through, blew off the roof. Like, that's a very unfortunate scenario. Things like stuff happens, right? On the flip side, it's like, hey, is this reoccurring, travel expense that is more discretionary, that isn't necessarily maybe a need, it's more of a want. If that is something that keeps coming up that's causing an issue, well, then yeah, there's probably you have to go back and relook at some of the numbers and identify, like, are you spending within your means, or are you spending outside of your means? And so I think that's where a lot of this, kind of comes in with an accountability partner and working with someone and helping them kind of guide you to, like, what are the things that are important to you, and what's the life that you're trying to live. And so, but yeah, one-time expenses, they do come up. They come up probably more frequently than people hope, and they always seem to come up at the worst possible time, right? So that's the way that life throws curveballs at us. But don't get too caught down in the dumps on that. It's part of the plan. Just know that, like, hey, try, if it's a reoccurring issue and these, one-time expenses are now becoming more annual expenses, at that point, it's probably not a surprise anymore. It's probably just part of your lifestyle. So just be real with yourself when you're thinking about some of those things. Well, good. Well, Teryn, I think that's all the questions and time we have for today. I just wanted to say thank you, Teryn, for co-presenting today and being part of the presentation. I certainly enjoyed the time we had together, and hopefully everybody who joined the call also got something out of this and found it really useful and helpful. So if you have questions, please don't hesitate to reach out. You can always schedule a phone call with us. Go to our website at savantwealth.com. You can get in contact with us either through our website or reaching out to us. And we are looking forward to seeing you guys again, hopefully on a future webinar. So take care and have a good rest of your day.
Thank you.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.